Rob Campbell, the mortgage broker. Some news coming out today about home equity lines of credit. Home equity lines of credit are a product that financial institutions offer to access the equity in your property whenever you need it, as opposed to a fixed or variable rate mortgage that would have a fixed or variable rate mortgage would have a one registered amount, and whether or not equity was dispersed at the time of closing, you'd be given that money by your lawyer or handed a check. But a home equity line is basically a glorified line of credit, but it's registered against your home. So you're able to get a much higher limit, much higher accessible amount on that line of credit should you qualify for it. And but most people don't know that that's actually a registered mortgage. That home equity line of credit is actually registered on your property, and it's something that is in fact a mortgage on your home. So a study was done by the Financial Consumer Agency of Canada, and these results have just come out. And I thought I'd go live here and talk a little bit about home equity lines of credit and some facts that the average consumer was polled on, and some facts that you might not know. If you have a home equity line of credit, you might not know some of these facts, because let's be honest, when it comes to the fine print, we never really pay attention to the fine print, do we? I know, I'm a mortgage broker, but I know if I go out shopping for speaking with my RSP rep or my stockbroker or car insurance, like I'm sure there's tons of fine print in car insurance that we don't know. We just don't know. Am I covered? I'm covered? Okay. And that's kind of how it is with a home equity line of credit. Do I have access to the money? Yes. Okay, cool. What's that going to cost me? Well, it's going to cost you X. Okay, I'm good with that. But what X is, that cost might actually only be interest-only payments. No principal reduction, which is not a great thing. A short-term home equity line of credit strategy might be a great thing. Or if you're doing something like a Smith maneuver where you're investing in RSPs and getting the tax from that, and that's a whole different video. But that's a great strategy. But maybe you don't know that your home equity line is it could be set up as interest only. So we're just going to go through some of this, some of these stats by the Financial Consumer Agency of Canada, or FCAC. Probably shouldn't have said that, but. So 27% of HELOC holders, so home equity line of credit owners that have a home equity line registered on the property, are making interest-only payments most or all of the time. So over about a quarter of the people who have a home equity line of credit are making interest-only payments. There is no principal reduction to that mortgage balance. Yes, a HELOC is a mortgage. Okay, we're not talking about a personal line, but we're talking about a secured line. Too many home equity line of credit holders are actually using them and overspending. So the polls are showing that, and we'll, I'll link it up. I'll link up in the notes here down below, or the comment section down below. Just look for the link for the source of the Financial Consumers Agency of Canada, their source and their data findings. But just wanted to cover kind of some of that stuff here today. So 1 in 5 borrowed more on their HELOC. Every time I reference HELOC, I'm obviously meaning a home equity line of credit. It's an abbreviation, home equity line of credit. 1 in 5 actually over borrowed on that HELOC more than initially wanting to do so. So they wanted to get $20,000 for home renovation. It turns out they actually funded more than the $20,000 or whatever that amount was that they were looking to take out. Almost 30% of people borrowed from their home equity line of credit to make payments on other credit facilities, credit cards, mortgages, or other loans, car loans, consumer loans. So about 30% of people who had a HELOC actually borrowed from their home equity line to pay off those other credit facilities, which is not a great strategy. Those findings show that, to me, I would assume that those findings show that most people are not really talking about the strategy of debt repayment, but are more so concerned about getting that credit facility to make ends meet with those minimum payments. So that's not a good thing. 41% of HELOC holders aged 25 to 34 admitted to paying interest only most or all of the time. So people between the ages of 25 and 34 admitted to paying interest-only payments most or all of the time. I'm just flipping through some stats here, my fancy stat sheet. What did most people end up doing with their home equity lines of credit? So once you get that home equity line of credit, what are most consumers that were polled, again, by the Financial Consumer Agency of Canada, what did most people do with those HELOCs? How did they use them? So about 49% of those polled use the home equity line of credit for a home renovation, which I would say as a short-term debt strategy is a great idea. You might be in a position where the penalty to break your current mortgage is just far too great to be able to utilize it for those home renovations. So you want to, let's say you want to redo a bathroom for 10 grand. Let's be honest. You're going to change a toilet. You're going to do the whole bathroom. We've all been there. You rip out the toilet. Now the floor is uneven. You got to rip out the floor. Well, if you're taking off the floor, you got to take the cabinet out. Well, if we're going to take the cabinet out, we might as well replace it. Well, if we're going to do that, we're going to replace the backsplash and the tiles. And well, why don't we just throw a no shower in? So, a toilet, I jokingly say, but I'm pretty sure most of you would agree that have gone through a home renovation in a bathroom. You go to change the taps or you go to change the toilet, the whole friggin' bathroom gets redone. It's just how it is. So let's say you need $15,000 to get that that bathroom redone. Well, if your mortgage is a fixed rate mortgage and it doesn't make sense to break that mortgage because the penalty is $20,000, why would you pay $20 to only get $15? Then you need another credit facility, right? And tapping into the home equity might be a great short-term debt solution, not to carry it past 6 or 12 months, obviously that balance, but maybe there's a buffer in there that's going to work. So anyway, 49% of people use it for home renovation. 22%, a staggering 22% used a home equity line of credit to consolidate their debt. So to use as a debt consolidation, they open up a home equity line of credit. Again, if most people, or if a quarter of the people are only making interest-only payments on a home equity line, and 22% of people polled are using it for debt consolidation, again, not the best way to utilize that credit facility. Purchase a vehicle. Others are almost 20% people polled used to purchase a vehicle. 20% just day-to-day expenses. Emergency fund, travel and vacation. I mean, if you're going to use a home equity line for travel and vacation, maybe not the best way to leverage your debt. There's other options that have points and rewards cards, but maybe not on your home equity line of credit. So, and only 11% use it for financial investments, which is crazy because a home equity line is a great way, like I said, to tap into something like a Smith maneuver or a tax vehicle for getting refunds, RSPs. There's other ways that you can utilize that. So consumer knowledge. Some of the consumer knowledge from the poll, about 1 in 3 know that lenders can reduce the limit of your HELOC at any time. A lot of people don't know this, but and a quarter of the people that were polled know that. Only a quarter of the people, which means 3/4 of people who have a home equity line of credit, don't know that it's a callable loan. The bank, the credit company or the bank that you have your home equity line of credit can actually call that loan at 30 days notice. Most often 30 days notice. Some might do 60. But I'm not entirely sure about that, so take that with a handful of salt. But basically, if there's a run on the banks and the banks want to call your HELOC and say, hey, Sally buyer who had that HELOC with us, we know you have $30,000 of debt on that line of credit, but we're actually going to call that loan. We want you to repay that loan now. And you have 30 days to figure that out. So it's a great vehicle to have for investing and a great way to utilize the equity in your property, maybe for buying a second property, again, for down payment and tax purposes. But day-to-day spending, not so great because it can be called at any time. Only 1 in 3 know about readvanceable mortgages. So whereby the HELOC's credit limit can automatically increase when a mortgage is paid down. So a readvanceable line of credit, an automatic readvanceable line of credit, is one where as you're paying your mortgage payment, every time you're making a principal payment to your mortgage and that principal balance decreases, over here, your limit to your home equity line increases. It works as a inverse way. So your fixed portion, your amortized mortgage portion, as you're paying your principal down, the line of credit limit, or your HELOC limit, actually goes up. So that's called a readvanceable home equity line of credit. A lot of people don't know that those products are out there, but they are. Only 3 in 10 know that there are fees to transfer a home equity line of credit to another institution. So again, it's not like although a home equity line of credit is open to repayment without penalty, it still is registered on your property. So even though it's a glorified credit card, really, using the home at your home as the equity source for that credit card, you can pay that out at any time. So if I have $100,000 balance on my home equity line of credit, and I don't know, win the lottery, or my great grandmother leaves me her estate and I have $100,000, I don't know, I got some rich friends that are paying me money, and I have $100,000 now in my hand, I can actually pay that whole line of credit off to zero balance with no penalty at all. However, that home equity line of credit is still registered as a mortgage on your property, still registered as a lien on your property. So although you have a zero balance, it's still there. It's still there in the shadows. It could be a zero balance, but it's still there. So a lot of people don't know that actually there is a cost to take that off of your property if you want to transfer that to another lender or just get rid of it altogether. Legal fees, discharge, all that stuff. So there's a couple of things that most people that have home equity lines of credit, or some people know that. 7 out of 10 do not know. Only 1 in 8 know that you can borrow up to a maximum of 65% of value of your property. So as per government regulations, the maximum that you can actually have on a home equity line of credit registered on your property is about, if your home value is 100% is the home value, you can only register to a limit of 65% loan to value on your home as your home equity line of credit. The other stuff, the amortized loan or the variable rate mortgage, can make up the other 15% to 80 or higher in some scenarios. So not a lot of people know that as well. And only 1 in 7 know that a lender can increase the interest rate at its own discretion. So again, just like the loan is callable, like the bank can call you with 30 days or 60 days notice to call that loan and repay it in full, they can also increase that rate at any time. So here's something to make note of when you're shopping for a home equity line of credit. You could be out there pounding the pavement trying to get the best deal on that home equity line of credit, and your bank or a mortgage or a home equity line through a broker, I'm not picking on banks, but your bank can say, oh, well, bank A is offering you prime +1 for your home equity line. We're going to offer you prime plus 0.5%. That's a better deal, right? Well, it is a better deal at the time of doing it. But in 60 days, in 6 months, in a year, they can just send you a letter and say, hey, by the way, we're just going to increase that interest rate. You have no say in the matter. It is in the fine prints. So just some interesting findings from the Financial Consumer Agency of Canada on the use of home equity lines, on some knowledge. Most people aren't really accustomed to the ins and outs of these products. They're great products to have if you know how to use them and you are aware of those terms and conditions. So I just thought I'd kind of reveal some of those survey findings for you. If you have any comments, please put them in the notes below, and I'll try to do my best to answer them for you. If you have a home equity line of credit and you're running high balance consistently every month and only paying interest, it's probably a good time to reevaluate that and reach out to somebody to see if you can get that paid out and closed, maybe into an amortized loan, depending on the loan amount, the home equity line amount. It's just really important that you focus on that debt, because if it's just an interest-only cycle, it could catch up with you. And feel free to reach out. So put a comment in the comments below, and hope that this brought you some value, maybe kind of give you a little bit of knowledge about home equity lines of credit. All right. Rob Campbell, the mortgage broker from the Rob Campbell Mortgage Team. And you can reach me at rob@therobcampbell.com, or therobcampbell.com is the website. Or like I said, just comment below, okay? Hope this was informal and formal and useful. All right, take care.